70% of all gold production in the U.S. comes from a single state, Nevada. Conventional wisdom says that all the good deposits have been found. But one geologist who's discovered more than 30 million ounces of gold says he knows where to find Nevada's missing gold. And right now, he may be on the verge of being proven right. Investors and speculators can learn more at futuremoneytrends.com/gold. Greetings and thank you for joining us at futuremoneytrends.com. I'm here with David Trungale. He is a leading analyst and the president of Trader Tours Investments. He's an independent market trader specializing in technical analysis. We've had him on the show several times now. Very accurate calls. He's one of those guys who way back when, I mean, he's a libertarian background, but technical trader, brutally disciplined and honest with his subscribers and to our audience. And he's one of those guys who, when everybody was really bullish on silver, he went short and he's made a ton of money. And he was very bullish on the markets when a lot of people were short against the markets for a lot of fundamental reasons that he'll actually tell you, yeah, he sees it too. But he's just following the technicals. He gave us a great call on Disney. I'm sure his subscribers made a ton of money. And I'm happy to have him back on the show to kind of just chat about the markets and what he's doing right now for him and himself and his subscribers. David, thank you so much for joining us.
You're welcome, Daniel. Thank you for having me again.
Well, hey, David, let's just start off with kind of what you're doing right now with your own money and what you're advising your subscribers, your clients to do. And basically, your general thoughts on the markets, on why you're doing whatever you're doing.
Sure. So at this current time, I am primarily in cash. Now, I do have a couple of individual trades, which I'm not going to disclose. I do have a paid membership, but I'm going to talk a little bit about why I'm in cash. So it mostly has to do with market mechanics. So again, my background, I'm a technical analyst. And that's just a fancy way of saying that I make observations. That's what a technical analyst is. We read charts, we make observations. And the mechanics look a little bit dubious on the Dow Jones, which was one of my major holdings for many years. You know, I go back, Daniel, to 2012 and 2013. Those were some of the best trading years of my life. And nobody wanted to touch the Dow simply for the reason that it was setting new all-time highs. Now, an experienced trader would look at that and say, you know what? The market's breaking resistance. We're not concerned about value. We're looking at the cold, hard mechanics. And sure enough, it ran very nicely into 2014. Now we're seeing a consolidation that is questionable. And because I'm not sure, I've elected to move to cash. So the beauty of cash is that you have the opportunity to go forward when you see the right mechanics or the right market move. So I'm just sort of waiting at this point. I do think there's going to be a major short selling opportunity in the markets ahead. I just haven't pulled the trigger yet because I want things to look a little bit better.
Yeah, so when you're looking at it right now and you're seeing the consolidation, you kind of don't know, and that's kind of where we were, I believe, a month or two ago when we spoke. It looked bearish, but it wasn't 100%. On the overall stock market, when you go in and you short this thing, do you think you'll go in with ETFs, with puts? How do you ideally like to go in when you short the market?
Sure. So I'd like to take a moment to address the subject of going short, obviously. There's a couple different ways to do it. You can do it the traditional way, which involves borrowing shares, generally involves a margin account, selling those shares with the promise to return them in the future, and then you're going to hope to buy them back in the future at a cheaper price and cover, and then you can pocket the difference. Now, the downside to selling short the traditional way is that if the investment goes up, in theory, you could lose infinity because there's no limit as to how high an investment can go. So what I do with my newsletter, I generally stick with just buying put options. I think you're mitigating a lot of risk when you do that. It's nice to know that in a worst case scenario, the most you could possibly lose is the premium that you pay. Now, a word or two about option trading. I get a little bit irritated about how the mainstream media labels options as risky. Yes, buying basic calls and puts are volatile. But again, these are all relative words. Risk is a relative word. I had a subscriber write in and tell me that he has $100,000 to invest. And I said, well, just buy one put option contract on this current trade we're going to do. The grand total, the premium cost $1,000. I told him, look, worst case scenario, you will lose that premium and your contract would expire. So that would amount to a 1% loss on his total account. And I said, most people would probably agree that a 1% loss on your total account is nothing catastrophic. On the flip side, you can do very well and gain some nice leverage on options. So a lot of this seems like common sense, but you'd be surprised how rare common sense is these days. So you have to manage appropriately and trade responsibly with options. I think a lot of people, where they get into trouble, is they start buying these calls and puts that are way out of the money. They're lured in by the cheap premium. And I can tell you, being cheap in the market will not get you very far. The further out of the money you go, the more of a gambler you become. So let's just say you have stock XYZ selling for $50 and you do a strike price. Let's just say that's at the money, maybe a little bit out the money at 47. Remember, you're paying a premium. Let's just say the premium is $1. The break-even point is going to be your strike price minus the premium, so that's 46. Well, understand, again, there's a time frame in your contract, so it's a little bit tricky. You could essentially be right, but if that investment does not fall by a certain amount and in a certain time frame, you can lose. So again, my caution with options is you have to be very diligent and very careful when you approach your exit and entry.
Yeah, that's interesting. I mean, some of the biggest profits for me personally has been in the options market, and it is that leverage. A lot of people talk about how real estate is very ideal because you have the leverage. Well, you have the same leverage in the stock market with options. Do you ever enter a trade with selling puts?
My newsletter and what I've been personally doing in the last few years, I generally stick with buying basic calls and puts. And again, the reason why I like to stay as a buyer on this contract is because I'm not obligated for anything. Now, again, there's hundreds or several, I should say, different ways to trade options and combo them in certain ways. I mean, you could sell out of the money covered calls, and that's a more conservative strategy than just owning the stock outright. So again, you got to be a little bit careful when you hear people say, hey, options are risky. Well, it's not really accurate. It all depends on what type of trade you're doing. But I like to stay as a buyer and stick with basic calls and puts in my letter. I like to keep things very simple so that my subscribers can follow my trades without anything getting too complicated.
Well, hey guys, if you're listening to this and this is a little bit over your head or you haven't heard of these type of strategies, check out tradertours.com with David, and you can get a subscription there and kind of walk you through some of these trades. I wouldn't recommend you do trades with your own money immediately. This is something you definitely want to learn about, and David's a great guy to teach you, and then put some money into these things. David, what about gold and silver? This is a very popular topic amongst my subscribers because we do have a concern about the macroeconomy. Now, I know that is not part of your trading strategy, looking at the macroeconomy or even the fundamentals. You're really just kind of just focused on the technicals, and it's really worked for you. What is gold and silver telling you right now? And then if you could take a look at the GDX or the GDXJ, kind of just look at that chart and tell us what it's telling you.
Sure. I'll start out with gold and silver as a whole here. So I still would consider this a minor rally within a long-term bear market. And I want to be very clear here because it gets really confusing. People say gold is up. That's true. Gold is up. But again, this is another relative word. Gold is up now here in October relative to where it was back in August. However, it is still down relative to where it was 1 year ago or even 5 years ago. So I want to be really clear here and just understand that within a trend, there are other trends. So the short-term trend for gold is up, and I would define that as a couple days to maybe a couple months. That's definitely up. The intermediate-term trend is going to be a couple months to maybe a year or so. That's sideways to bearish. And then, of course, the long-term trend is going to be 1 year and beyond, and I think that's the most valid picture, and that is bearish. So again, I just want to be clear, make sure there's no confusion on that. Overall picture is still bearish. I would probably believe that this is a short-lived rally. However, if gold does keep going up, my stance could change. I've been pretty consistent as far as being bearish on the metals. I remember I started shorting silver at 35 an ounce, and I told people it was going to 12, and no one believed me. Then I came onto YouTube a couple years ago, and I said I was going to 12. And I think the lowest low that we made this year was $13.95. So it looks like I was fractionally off, but there's a couple months left in the year here. Now, as far as GDX goes, I want to take a look.
Real quick, just to give people an idea, what would change your long-term view of gold? Would gold have to break the 200-day moving average? Would it have to, do you have a price number that we could, I know I didn't have you prepare for this before the interview, so if you have to ballpark it, just give us an idea of what would change your view of gold.
Well, that's a great question. And, the thing about technical indicators, Daniel, is there's really not a magic bullet. Everyone's looking for this magic trading system, and it's not that Bollinger Bands are better than the RSI. You should just use these tools as a general guideline to give you a feel of where we're at. So it's not like there's a magic target I have. I'm just looking at the chart here. I would first of all say that gold would have to break some resistance, so it would have to crack over 1,200. And yes, the moving averages, I like to use simple moving averages. I would like to see gold well above the 200. That can mark a major change in the trend. But again, it basically would have to have more momentum. I just like to draw various resistance lines on the graphs, and it gives me a feel for where we're at in the overall market. So this would need a little bit more power in order to break out any major trend line yet. So I don't really have an exact number. But moving on to the GDX, again, very similar pattern here. Very small, minor rally as far as where we are at in the grand scheme of things. Obviously, if you want to play the market in the short term, that's another story. If you would have bought in September and sold out today, you would have done very well. So again, there's multiple ways to trade. I know I'm speaking in very general terms here, but it's true. Some guys like to play the short-term trend. Some guys like to, they're swing traders. Other guys like to buy and hold. So it all depends on your strategy. It's not that one way is right or wrong. You just have to figure out what works for you as an individual.
Yeah, and then when you look at a lot of the fundamentals out there, the mining sector, the sentiment is the gold sentiment is at a historic low. We were talking about the mining shows before this interview. The mining shows are all washed up, and nobody's showing up at these events except for the companies. And even then, it's just a handful compared to what we had a few years ago. Does that play into when you look at the technical analysis? Do you ever consider the fact that this sector is cyclically at a low?
I do not. The reason why is because, again, to boil down technical analysis and just avoid all the jargon here, we're making observations. And what the charts show you is what literally is happening. We talked about manipulation in our previous interviews, and I don't deny that at all. In fact, just about every market's manipulated to some extent. Now, there's something called an efficient market hypothesis, which is a very interesting theory that says that all prices right now account for insider transactions and all data out there. Now, the other part of the theory, though, that I disagree with is it states that the market can't be beat. Now, I think that's ridiculous because you have to understand what a market is. It's basically trading between people, right? It's determined by buying and selling forces. So if I, again, buy a call option for $500 and that premium expires, it's not like my money just evaporated up into the sky. That money went into somebody else's pocket. Therefore, you can place winning trades and losing trades. So nobody can, quote, beat the market. But again, you can place winning trades and losing trades because we are investing against other people. So I don't see, back to the original question, I don't really care that much about the sentiment. I look at the cold, hard mechanics, and that's what I use to determine my decisions for investments.
Are there any sectors or trades that you're kind of watching that, it looks like there might be a major breakout, something that, you're not ready to alert your subscribers to, but something that might be coming up here in the next few months?
Well, I was kind of keeping my eye on Wynn Resorts. It's been a long-term bearish trend, and I'm not actually looking for a breakout. I was actually looking to short it, and I was waiting for a minor rally, which actually occurred early in October, and I did not pull the trigger, and it's already down about 15 points from that high earlier this month. So I'm just being pretty conservative here. I have several trades on my watch list, but I'm not screaming to buy anything right now simply because I don't see the trade. And rather than force a trade, I would rather stay disciplined and wait for the right opportunity to come up.
Yeah, when you look at the markets in general right now, Just technically, not even technically, just we were talking about before the show again, I'm seeing these layoffs happen just like it did in '07. Does it feel like, even just going outside of what you do in the technical analysis, just as somebody who observes the economy and the markets, does it feel like that the U.S. is about to possibly enter into a second down leg or another recession?
It certainly could. I would not rule it out, and I think that's part of the reason why I got out of the market is because things just didn't feel right. And like I said before, I'm a bit dubious here. Is a bear market imminent? Hard to say. Again, I know I'm kind of leaving people on hold there. That's pretty much the same response I had a couple months ago. But again, these markets take time. Everyone's looking for, Dow Jones 40,000 or Dow Jones 1,000. I've tried to hammer on this before. It just doesn't work that way. Like I said, the 2008 crash took many, many months to fully play out. I mean, the Great Depression, we're talking about years. So a lot of these bear markets that are cyclical and are major, again, like you said, there's counter moves, there's psychology. It takes time to develop. So could this be the start of a bear market? Absolutely. Is it for sure? I don't know. Again, that's part of the reason why I'm holding on to cash.
Yeah, it's so funny. You hear a lot of these shocking numbers. I know one editor at a major newsletter talks about Dow 50,000. And then there's another editor of a newsletter, but he also is a popular author of books, and he's calling for Dow 1,500. And it's like these shock numbers, and
right.
It's hard to say that. I mean, I don't want to rule anything out, but I mean, especially on the downside, you got to consider the fact that, the entire pension system and the U.S. government is completely dependent on this thing going up. So there's a heavy bias of it going up. And one thing I talk about with friends and, in our own paid newsletter is I just did an article on this, is that there's an SP 500 bias to go up because the SP 500 is constantly removing the weak ones and replacing them with better companies. It's not something that's just, people think of the S&P 500. It's not the same stocks of 1970.
Oh, you're absolutely
in fact,
right.
I think there's only like 84 of them, 84 originals out of the 500. There's a major bias for this thing to go up. So, I mean, there are times, of course, just as you're describing, to short the market, to go bearish, but there is definitely a bias of bullishness because of, these things are not stagnant. There are a lot of forces that want them to go up. Humanity in general, especially right now, you can't be all bearish because of sovereign debt and all the crazy things government is doing when you consider all the great things that are happening in Silicon Valley, in Austin, the technology and that part of our world is on like a parabolic curve right now where our lives are getting better and better and better. And man, if you can just live another 20 or 30 years, who knows, you might live to 200 or 300 years old.
Right. Yeah.
So anyway, well, hey, David, I appreciate your time. Love to have you back on the show in about a month or two. David Trungale of TraderTours.com. If you guys want a subscription, check it out. TraderTours.com, technical analysis, and try to get into some of these bigger trades and calls that David's making. As you can see, just by listening to the show, he's very conservative. He's not rushed into getting into a trade. He's not holding himself to any kind of mandate where he's got to give you a pick a week or a pick every Thursday, something like that. He's really looking to have that like sniper style investment. He makes sure it's clean. It's got the odds for you. And then of course, actually, David, if you want to talk about real quick, you also have a stop loss strategy, correct? In all your trades?
Not all of them. I do like to use a stop loss though. And the basic premise here is just to know your risk when you go into every trade. Again, this sounds like common sense, but it's really not because I see so many people fail to do this. You have a $100,000 portfolio, and you hear these people, or you could even be 10,000 or 5,000. Whenever you hear these nightmare stories about people losing everything, it's because they didn't apply risk management properly. They didn't use a stop loss. They didn't know what type of trade they're doing. And again, not to disparage the value investors, but that's one of the reasons why I don't like accumulating more and more shares of something if the technical picture looks ugly, because rather than mitigating your risk, you're increasing it. If you just keep buying something and it's working against you as it goes down and down, you're going to increase your losses opposed to cut them. So yes, I think stop losses are very important. I ideally like to tuck them just under a major support level. But again, there's more than one right way to trade, or it's not that there's one way to do things that's right or wrong. You ultimately have to find out what works for you.
Yeah, in my opinion, one of the greatest scams pulled over the public is the dollar cost averaging, because, the whole 401k and the retirement cartel, they have convinced every, adult that makes a decent wage to just buy no matter what on the 1st and the 15th. And right. I just think of all the fees that Wall Street collects and all the selling, and they're able to trade. They've created this permanent, just crazy buyer that just comes in no matter what on the 1st and the 15th. It's just lunacy, but I mean, that is definitely that is like etched in stone, man. You go against the 401k or dollar cost averaging, and man, everyone turns on you because it's so ingrained in everybody, and everybody's been conditioned that that's the way to go. But I mean, that's really stupid to dollar cost average, at the end of 07 and 2008.
Well, I agree. And one last video too, I wanted to alert the audience there. Check out my recent video I did on Mark Cuban. He talked about just holding your money in cash. And there was an old man initiating the interview that almost couldn't believe what he was saying. He goes, well, you have to park your money somewhere. And Mark said, no, you don't. Just keep it in cash if you're unsure. And, of course, like you're saying, with the 401ks and mutual funds, you got penalties, fees. If you want to withdraw your money, it's not liquid. I just don't see that as a very wise investment. For some people, maybe it works out. But again, with my success in the market and the people that I work with, we want to stay liquid. We want to have capital. We want to be ready to seize the right opportunities in the markets.
Yeah, and when you have a cash position, if the market goes down, it's like a short. Rick Rule talks about how it gives you courage to buy. If you're concerned about a currency crisis, just as I am a potential crisis in this world, I mean, it could happen at any time. But you should have, in my opinion, once you have your insurance, which is either for people gold and silver, it's going to be an income producing business or hard asset or real estate or whatever it is. I mean, there's nothing wrong. In fact, it's very good to have a good cash position ready to seize on opportunities. I think about people who had, like Marin Katusa talks about. Marin Katusa is a specialist in the resource sector. And this guy has been over 50% cash in the resource sector since 2011. Mm-hmm. He took a picture at a Canadian resource show in January of 2011, and I'll never forget it. It was a picture, and the place was just had people coming out. I mean, it was just flooded with people. And he took a picture of it, and he put, "Is this a bubble?" And obviously he was heavy on cash. And it served him well because a lot of his competitors, heck, a lot of the funds that are specialized in the resource sector are gone. And there's a good, I think, 700 or 800 companies that are about to get delisted over the next year because they spent all their money. So I mean, it's an important position that I think isn't focused on enough, especially either for people who are focusing on retirement or people who are focusing on a currency crisis. Cash still serves a great purpose, and that's great advice. All right, everyone, check out David Trungale at tradertours.com, and also check out this video. Is this the 3 simple trading stock tips?
Yep. Okay, I have that right on my website there. Just 3 very basic things you can do that should immediately make a change for the better in your portfolio.
All right, David, thank you so much for your time. You have a great day.
Thank you, Daniel. You too.